traders, welcome back to another diary entry. And today in this diary I'll be talking about what divergence is in forex. And as we can see the subheading here, it's hints at future changes in the direction of the market. So I'll talk a bit about how you use divergence in your trading and what that looks like. So let's go into the introduction. So essentially, divergence is a kind of early warning sign. It's a sign that shows you that something is about to happen in the market. You may want to pay attention to it when price says one thing, but in fact, your indicator says something else. And that will be a warning sign for you to know that perhaps you should consider taking action. So, very rough example here. We see the market making new highs and new higher lows, and it is in its upward direction. However, we have an indicator here which shows the opposite, making lower lows and lower highs. So in fact, what we have here is a divergence in direction, where the markets, the two things you're looking at, price and indicator, diverge in price. So we go one way and then the other way. Convergence would be in the same direction, and divergence would be in opposite directions. So, as I was saying, it hints that the market is about to change, and it can be used with different indicators. So, most popular one is RSI, which is what we see here. And you can also use it with correlated markets. So, just as an example, if you are trading the Australian dollar, shorthand is AU, the correlated market to that would be New Zealand dollar, shorthand is NU. So if you see the Australian dollar going up and the New Zealand dollar going down, and you're looking at the Australian dollar and you're considering when to take a trade short, you can see that the New Zealand dollar is beginning to go short. Then you can, by correlation, you can then expect that there is a higher probability that the Australian dollar will begin to also reverse and go down. And the same is true in the reverse. So if you want to see the correlated pairs, you can have a look online and check them out, and then make a note of that for your reference. So in this basic example, it's Australian dollar and New Zealand dollar. As we could just see, price shows one thing, an indicator shows another. And that is how we begin to better read the market and understand what's actually going on in the background. And how is it used? Well, used as a confirmation to enter. So in this case, we will be looking to enter short because the RSI here is indicating that the market is beginning to weaken. And also used as a signal to exit. So in this case, if we were buying this market and we can see this divergence, then we may want to close our trade here and take profit. Let's look at a chart now. Our example we were talking about, the dollar yen. So let's, for example, assume that we placed a Fibonacci, we have a level here. We saw that there was a reason to enter the trade somewhere around here. And now we were looking for confirmations. We did all our checklist, everything that we wanted to see on the chart. And then lastly, we look at the RSI and we can see that there is a divergence. Very clearly, the market is going higher, but the RSI is indicating lower lows, and therefore we can here look to place a trade short. And trade it down. And then we see what happens. So the opposite is also true. If you would like to buy, it's the same process. To look at a buy, let's identify that, for example, we want to buy at this area here. We can see that together with all our indicators, the market was creating new lows, but the RSI is creating new highs. And this would be our buy position. And if we did short from here and we were down here now, then we could see that because of this divergence, perhaps it's time to exit the trade, because we have an indication that the market is reversing. This is the indication of divergence, of changes in the market behavior using the indicator, using the RSI. So that was the example with the RSI indicator. So now we can just get rid of the RSI and we can look at our example of Australian dollar and New Zealand dollar correlation. So the chart here shows the Australian dollar, and we can see that the market is making lower lows. We could see that we are now heading down. However, if we're thinking of placing the buy trade and buying this market, we want some more confirmation. So what we can do is we can place the chart of the New Zealand dollar over the top, and we can compare what the New Zealand dollar is doing at the same time. And what we'll be able to see here is, in fact, while the Australian dollar is heading down, making lows, you can see that the New Zealand dollar is actually making new highs. So here we go. This is the example of price divergence in correlated markets. And this will give us a hint that perhaps this is a higher probability buy, and this will confirm our trade together with all the other factors, all the other analysis that we're doing at this time. So that is clear divergence, and at the same time, in this case, even further confirmation is the fact that RSI is also diverging in price, in market price. So you can use both. For simplicity, it's best to use one, and notice how price moves in conjunction with the divergence of the indicator that you're using. A summary of divergence, and hopefully that will help you make better trades, more improve your accuracy, and make you more profitable. So thank you very much for watching once again. And a final tip: the markets can be choppy, so choose only the obvious and clear divergences, as we've looked at today, at the time that you enter. Do not anticipate it, just look at it when you are entering the trade. Thanks a lot, and see you on the next video, diary entry.